Now, I know the international financial reporting standards have changed drastically. I mean, it's doing 360-degree turns in terms of its application. Now, when it comes to the point of discussion today, which is on revenue recognition, how does the current standard change? I know the new standard is applicable in 2018.
Yes.
Is that right?
That's correct.
But early adoption is always permitted.
Yes.
Now, what is the main change from the current to the new standard?
When it comes to revenue recognition, the main change is the previous standard was developed a long time ago, which didn't take into consideration the development in the markets and the development in different industries. So the new standard tries to capture all that by establishing certain principles in adopting how revenue should be recognized. So that is the fundamental thing. So it has coordinated a lot of bits and pieces of information, and now it has got a composite standard. Now, one of the critical switches that is taking place in the world of accounting today is we are coming from an era where we accounted for transactions. Today, we are now saying that a transaction is as a result of a contractual right or an obligation. So we are now moving towards analyzing contracts and looking at the implications of those contracts in the case of revenue or in any other field as well. So that is one of the fundamental changes that is taking place. The next thing is
So the entire revenue recognition framework is contract driven.
It's contract driven because it says recognizing revenue with contracts with customers.
So from what I understand, those days in the previous standard, you didn't look at the technical end, like the functionality of the system, what functionality is critical, what functionality is not critical.
Yes.
But the new standard, it goes into the extent of which functionality is critical and how do you basically use the functionality to allocate revenue and things like
Correct.
that.
So as a result, you might have a completely different answer from what you were doing in the past. Then also it analyzes in your industry things like intangibles, like you give a license. Now, is this license a one-off license, or does it give a right to use this license over a period of time? So now, depending on how your contract is designed and what rights you have conveyed to the customer, you can either recognize revenue upfront or you can recognize revenue over a period of time.
Okay.
So it can have a major impact if a company is selling licenses for the right to use the software. So it can have an impact. That's one issue. The other issue is this IFRS 15 it goes on a 5-step model. Now the 5 steps in that model seems very simple, but the application of that may not necessarily be simple.
It's very judgmental.
It is judgmental because the standard talks about principles and not necessarily rules. So when there are principles involved, the judgment element comes into play.
And from what I understand, let's say if there's a particular client and from the first day of invoicing, you need to assess and see whether the repayment can be made or not.
In step
Wasn't this there in the previous standard as well? Or?
It wasn't there in that form. Generally, you would evaluate a customer's recoverability when the customer maybe stops paying.
So it goes into bad debts and then a bad tax provision and then a write-off.
Yes. So there are impacts, and one of the impacts I keep enumerating to people is that even though these standards are financial reporting, it has a lot of business impact. So the business has to have some understanding and appreciation of how what they do is finally reflected in financial statements.
Yes, but what happens most of the time is the business heads or the CEOs go and negotiate the contract.
Yeah.
And then the contract ends up with the CFO.
Yes.
All the CFO can do is basically apply the standard and account for it.
Exactly.
Right, but the understanding of how the negotiation took place and how it impacts the financial statements are not taken into consideration at any point.
Yes. It's only as a point of reporting.
Yeah, that's where the breakage happens.
Correct.
And that can have impacts on compensation.
Yes.
And especially if you're a public listed company, it can be disastrous.
Correct.
Because your investor expectations are different to what you're reporting.
So it can have impacts on your budgets. You have budgeted based on the actual number of contracts you have sold and maybe the revenue in that or whatever it is. But then comes the revenue standard and says, no, you can't recognize some of those as revenue, or you have to recognize it upfront, or you have to recognize it over time. Now, as soon as that happens, and if you are evaluating performance based on budgets, you might turn around and say you have not met budgets. But then your sales guys will say, no, I have signed all these contracts. So the appreciation of this standard is vital for operations. Then there are other impacts. Say if your people are compensated based on performance, say bonuses and things like that. Now once again, all these things, the fundamental way of calculating or to see whether you have achieved your targets is financial reporting. So if your financial reports carry a number which is different to what you envisage, then that whole chain gets impacted. So your bonuses can get affected. You can have impacts on your debt covenants. Maybe you have borrowed money, maybe some investors have given you money, but then they would have put certain conditions in those covenants. Now again, the covenants are checked back with financial performance, which is the financial reports. So if these reports are going to be impacted by the standard, clearly all these things are going to get impacted. So from a taxation point of view also, one has to be aware that it can have cash flow impact. So sometimes you might recognize revenue where the cash flow is not there, and in other times you might have the cash flow and not recognize revenue. So there is a critical impact on taxation. Now in addition to that, your KPIs, revenue has an impact on KPIs. So you might incentivize your marketing team, or you might incentivize the operational teams based on certain performance indicators, which might ultimately end up in revenue. So the revenue recognition principles will obviously have an impact on.
So then there's a tussle between the finance guy and the marketing guy. Exactly. That's why the commission was not paid.
Exactly.
So you made an interesting point, Manil, on the invoicing side. So just because you raise an invoice and collect the money doesn't mean that you can recognize revenue.
No, because revenue recognition is based on performance of the contract.
Exactly. And then you might have to pay tax
on the invoice.
On the invoice. You might have to pay VAT on the invoice, but you can't bring it to revenue.
No.
So when it comes to inland revenue, there's a reconciliation issue mismatch there.
Exactly. So you can have that kind of thing coming. In addition to that, there are certain other complexities that are coming from this new standard. Say for example, when you are bundling services, in your industry there is a lot of bundling of services, like you might sell hardware, you might sell software, you might sell maintenance. So there's a lot of bundling, and sometimes for this whole bundle you get one price.
Yes, sir. I mean, most of them, what happens is when you buy the hardware has a software.
Yeah.
Right, and then you get 5-year maintenance free.
Yes. So now the standard looks at these as independent performance obligations, purely because the performance obligation itself is performed at different times. So when you sell the hardware by delivering and making sure it works, that obligation has been delivered. But when you take the maintenance, it has been delivered over 5 years. So then the revenue has to be recognized over 5 years for the maintenance part, but for the hardware part, you might have to recognize revenue immediately. So you have some implications on these bundled contracts. The next issue in the software industry that is very common is that sometimes you enter into a contract, and then after a while you enter into another contract to do an additional piece of work. Now the question is,
or a main contract.
Yes. So the question is, with that second contract, you would have never got without the first contract. And now, if you have a pricing difference between the first and the second contract, then that has to be looked at from a total contract point of view. So there are a lot of things that the industry, to the software industry practices, which will have an impact on the revenue recognition principles that are being enumerated in the new standard.
I think the main problem that I see in the application of this standard is, at the point of negotiation of the contract, with the people who generally get involved are the business people.
Correct.
So at that point, you basically run a negotiation process.
Yes.
Your last thing in your mind is the revenue recognition.
Yes.
Right? But the thing is, you negotiate the contract, sign the contract, right? And most of the time in our industry, it happens in different countries.
Correct.
Right? Then the CFO gets hold of that contract and he looks at the revenue recognition,
yes,
and he says, we can't meet this forecast because we can't recognize the revenue.
Correct.
Now that is a big problem because that affects the compensation, meeting of the budgets, and if it's a listed company, then it has impact on share price. Now how do you sort this issue?
Yeah, the important thing is now almost all the people in the organization, operational and marketing, has to have a basic appreciation of the standard and the basic principle that the standard is trying to enumerate. Because then at the time of negotiation, you know that if you don't do certain things, that this is not going to result in the recognizing of the revenue. Now, from a business point of view, you might still have to do that, but then you are aware that the revenue is not going to be recognized. So it's not a question of that you should modify your business terms to suit revenue recognition. It's a question of you being aware when you do the business,
That
the
is the
implications
revenue
that the
impact.
revenue impact will have on reporting.
And then you build that into your forecast.
Exactly. So that is a critical fact.
Now, how does one go about, let's say, if you were to go for early adoption, right? Because from what I understand, this entire revenue recognition process is contract driven. The contract is a primary tool in recognizing revenue and the contract terms.
Correct.
Now, we have maybe 2 years, right, until it's mandatory for application.
Yes.
So, if you are to advise a company today on what steps they need to take to pave the path for its implementation, what would you tell them? What do they need to do?
I think companies first of all needs to do an analysis, a gap analysis, to see in the business model that they are following today, what are the likely impacts that they are the impacts that is likely to happen if you were to implement the new standard. That is one thing. Then the application or implementation of the new standard also requires a company to be ready in order to successfully implement it in 2018. Now the readiness will require certain steps to be taken over the next 2 years, like gathering data, looking at behavioral things. So in order for you to gather that, you require time. You can't come to 2018 and all of a sudden decide I'm going to implement the standard. So that preparation time only will ensure a successful implementation of the standard or adoption of the standard. Now if you don't do that now, the chances are that you might have some problems in implementing this standard. That's one thing. The other thing is the business also needs to get oriented towards the implications of this standard. So when you are signing contracts, let's say in end of 2016-17, which might flow through to 2018 and 19, you need to be aware of the implications the application of the standard in 2018 is going to have on the contracts that you have already signed.
Or even existing contracts.
Exactly.
Existing long-term contracts, and
That's
most of software contracts are for 5-6 years
Exactly.
plus.
Exactly.
So you need to basically assess the impact of those contracts, right, on your future revenue.
Correct.
And forecast it.
Correct.
And show the and how do you show the growth story?
Yes.
One of the other things that I was thinking of just now, Manil, was contracts become critical, and most of our companies don't have systems that manage contracts.
Yeah.
Right, but going forward, you need to have very robust contract management systems to track clauses.
Correct.
How do you go about with it?
I think many companies in Sri Lanka, not only in the IT industry, in almost all the companies, as I told you, we are coming from an era where we accounted for transactions. So all our systems have been configured in order to trap transactions. None of our systems have been configured to trap contracts. So there has to be some degree of reorientation that is going to take place, where we now start to identify contracts and try to maintain a centralized contract database so that it can then lead to better financial reporting.
Okay.
So that's critical that we need to do that.
One of the, I know we spoke of revenue recognition, but one of the aspects I wanted to briefly touch on, Manil, is now Slascom as a whole, as well as our industry, is looking at taking. So we have a lot of development companies, but for us to go up the value chain, we need to build products.
Yes.
Right, that's the only way to increase revenue, margins, right, and to have a global footprint.
Right.
Now in product building, what we do is, there's a possibility of capitalizing this cost, showing this the cost that you incur to build the product in the balance sheet as asset. And when investors see that value, they see the asset value of it and not the expense value, right? I mean, how does one go about it? What are the concepts involved in product capitalization in our industry? Because at the end of the day, we are a industry dominated by intangibles and intellectual property, right? So how does one reflect that intellectual asset that he owns and has, which might have IP, in the balance sheet through capitalization?
In this field, current accounting framework has definitely a standard on intangible assets, and this development cost, if the product development cost clearly can be capitalized as value or an asset, provided it meets certain conditions which are laid down in the standard. The research cost obviously cannot be capitalized until such time you know that you are able to develop a product which has commercial validity. So at which point you can start capitalizing the cost. So there are standards which govern that, and which will help you to then probably show value in your business. But in the accounting field, this is, I think, it's in the infancy. There is a lot more that has to happen for you to really bring the value of these intangibles to the balance sheet. That probably might take a bit of time.
Okay.
But at the moment, there are the standards which brings software development. If you are developing a product for marketability or for future marketing, the intangible of that can be brought into the books as an asset.
If you take a startup perspective, let's say a typical startup building a product, let's say what are the main criteria that would help them, let's say, capitalize this cost? I know it's a bit of a...
Yeah, the principal thing is that I think that product has to be covered by some legal rights so that no one can copy it or anything like that. So that has to be established. Then you should establish that this can generate future cash flows.
So should you have a contract or a customer in place?
Not necessarily, but you'll have to have a prototype, and someone need to have to show that it is a product that can be commercially marketed, and there is possibility that cash flows can be obtained. So there has to be. So if it's a greenfield product, sometimes it's difficult to prove some of those requirements.
Okay.
Because you don't necessarily have a market, you have to develop it and things like that. But if those can be demonstrated, in principle, you can capitalize.
So let's say we have a scenario like, Pikmi in Sri Lanka copied, let's say it's like the Uber.
Yes.
So if Pikmi does a development cost, in such a scenario, you have a model in place, the model is working, prototype is working, can you capitalize in?
Yes, you can, provided you have legal rights over it.
Okay.
You own those then those can be, it's individually freestanding, which means it can be sold.
Okay.
So as long as those criteria are there, and you can demonstrate commercial viability through future cash flows and things like that, you should have no problem.
So what would be the main advantage that the company would have in showing that value in the balance sheet?
Main advantage is the company value, because this intangible which you have, this is this whole thought process, the development, the idea, that whole thought process is not valued, because what has happened is what is capitalized in the company is what has gone to develop it, but it doesn't really show the potential of that asset, because it's theoretically kept at cost.
And it's written off to P&L.
Then over a period of time it will be amortized or written off to P&L.
So at which point do you start writing it off to P&L?
As you use it, and if you
it's commercially deployed.
Not only commercially deployed, as you lose value. Now sometimes it need not be written off to P&L.
Okay. Or you can keep it in the balance sheet.
Yeah, it all depends on whether this asset will depreciate over a period of time or over usage. Now most of the cases intangibles don't do that, but in intangibles there are some rules within the standard which says that you can't have indefinite life intangibles unless you can prove it.
So Manil, in the ride sharing example that you spoke of a few minutes back, let's say a company similar to Uber, if they grow their subscriber base, right, we know that with the growth in the subscriber base, they gather more information about the subscriber and the business value also increases. In such a situation, can they keep that asset in the balance sheet without writing it off, charging it to P&L? Or
theoretically I suppose it works, but if you look at the real practical scenario, in most of these cases there will be competition coming. Say for example, when Uber started, there probably wouldn't have been competition. Now you have Pikmi, you have My Taxi in Malaysia, so various other companies are also coming in,
copying the same model.
So therefore, in any intangible, it will be very rare to say that it will have an indefinite life. So you will always have a life because due to competition, due to various other reasons, you will not be able to sustain that intangible forever.
I think it's been a very insightful discussion, Manil, and your experience on basically marketing a business financially will, I'm sure, add a lot of value to our subscribers and whoever watches this video. So thank you for watching this video. You can subscribe to us on our Facebook page, which is /com CFO Forum. Also, you can subscribe to our YouTube channel, which is /com. And what we will do is we will monthly share a video of what we similarly did to bring in various thought processes, especially on the digital world, what is happening around us, how digital disruption is taking place, in order to educate and inform the finance professionals as well as other professionals as to how we can take our industry from a development standpoint to a higher ground, which is product development. So thank you for watching this video, and please subscribe to us and watch our next video, which will be a monthly video. Thank you.